Hi guys, my name is Tom. Welcome to this week's video on different ways to trade options. Over the course of weeks and months, we are going to teach different option terms, strategies, and techniques to our viewers. Our ultimate goal is to educate you about the wonderful and highly profitable world of option trading. As always, don't forget to click the link and subscribe to this page and receive alerts when they are posted. Also, please feel free to follow us on social media. We're active in Facebook, Instagram, and Twitter. So let's jump to this week's video, which is different ways to trade options. Important refresher. What are options? So options are contracts that give the bearer the right, but not the obligation to either buy or sell an amount of some underlying asset at a predetermined price at or before an expiration date. Option contracts are financial agreements between two parties to facilitate a potential transaction on an underlying security at a set price called strike price prior to an expiration date. When you buy an option contract, you are choosing to exercise your option contract on or before an expiration date, or simply allow the option to expire unexercised. Options are an example of derivative. So a derivative's price is dependent or derived from the price of something else. Examples are derivatives. Wine is a derivative of grapes. Fruit juice is a derivative of fruit, of the underlying fruit. And then finally, so an options contract is a derivative of stocks. One option is called a contract, and each contract represents the ownership of 100 shares. So if you buy or sell 200 shares, your position tracks the movement of if you buy or sell two contracts, your position tracks the movement of 200 shares. If your option expires in the money, then the owner has the obligation, but not the right to buy 200 shares of the underlying stock. So what are the two main ways an investor may participate in the option market? Well, it's very, very simple. The two ways are you buy and you sell, or write, what we call. So when you buy an option, contract, you purchase the right to either buy a call option or sell a put option, the underlying asset at a set price, which is called the strike price, upon a certain date, expiration date. If you want to sell an option, or what we call also write, those who write an option contract are effectively selling the rights to conduct the trade, but for a premium. So when you buy an option contract, you are buying a previously written or sold option. They work hand in hand. So buyers and sellers. So a call option buyer, if you're buying a call option, you're profiting if the underlying asset rises above the strike price. You buy it with a strike price of $10 and it's good, and it rises up to $15. Then you make a profit there. A put option buyer profits if the underlying asset falls below the strike price. You want the price to go down, so you buy it at $10 and then it goes down to $5. You make a profit on that side. The seller of the option contract, or the writer, so a call option writer, profits if the underlying asset stays below the strike price. So this one wants to go up, writes it for that, so it stays below it. They will lose all their money and the writer will keep the premium received. And the put option writer profits if the underlying asset stays again below the strike price. Again, non-profitable. A seller makes money because they sell it, they pay a premium. So an option buyer can make sizable returns on investment if they predict correctly. This is because the underlying stock movement can, move significantly beyond the strike price. If it can move from anywhere up, it's unlimited. And there's no cap on how much an option buyer can make. They can make infinite amount of money. However, there is a cap on how much they can lose, because if you invest $100, the maximum amount you can do if you're buying it is lose the $100. The seller, or the option writer, will make a comparatively smaller return if they predict correctly. However, because this is because the writer's return is limited to the premium received, no matter how much the underlying stock moves. They write an option contract, they think it's either going to stay below the strike price or above the strike price. So they could sell it for, let's say, $100. That's the amount of money. That's the maximum amount they can receive on that. The caveat is when you purchase an option, investors may or may not see that it's good. Yeah. So the caveat is when you purchase an option, the chance of you making your money is less, statistically less than selling it. So that's why people sell. There's a higher probability that's going to happen because statistically it will end out of the money if you look at it over the long frame. So you need to understand those two terms, and especially what do they look like when you jump into a brokerage platform. So let's jump into a brokerage platform and see what it looks like. So when you open a brokerage platform and you go to an options tab, and the first thing you'll do is you select an action, and you'll have this drop down menu of buy open, sell open, buy close, sell closed, and you need to understand what each one means before you execute it. So let's look at the first one, buy open. So buy to open or buy open is if you're buying an option, whether it's you buying a put or a call, you must enter buy to open. That's how you enter it. That's how you start the options contract. Sell to open. If you're writing an options contract, you must sell to open. So, you're starting off the position. This is the beginning. This is the both buying, opening a contract on both the buying side and on the writing side. So you're buying to open, sell to open. Key there being the word open. Now, selling. This is when you're closing the contract. You're exiting out of it. You want to lock in a profit or you want to minimize the loss. So sell to close. Sell close. Is it to exit an order, you must close your option position. If you bought an option, you must use sell to close. Now, the flip side of that, buy to close. So if the trader is a net short an option position and they want to exit that position, the investor would use buy to close. Now, you need to understand those terms because you don't want to select the wrong one. Now, normally, if you don't have if you didn't have an open position, buy open, you went sell to close, I don't know if it would actually allow you to do it, but some people could make the mistake. Normally people do is they have an open position with options contract, buy open, and they click sell open. So that's when it'll get you into trouble because you'll be opening up a new options contract. So, buy open, sell open, buy close, sell closed, making sure you remember that. So that is the ways that we trade options on the market. Thank you so much for watching this video on different ways to trade options. It's been great sharing with you. Please click the link and subscribe to this YouTube channel. Please also click the link to our website. We also are active on social media on Facebook, Instagram, and Twitter. And we'd love to hear from you. So please stay tuned for more content next week. Thank you very much. Bye-bye.